Hello there, this is binaryoptions.com, and still under the Elliott Waves theory, we're going to look at some generalities on the Elliott waves. Going to list some of them in the category of tips and tricks. So Elliott Waves Theory, tips and tricks. Let's put it in here. Tips and tricks. Well, the first thing that should come to mind when you trade with Elliott Waves theory and you look at the move is to ask yourself the very important question. Number one, if you look at the move, is the move impulsive or corrective? That is the very first thing one needs to hear. Is the move impulsive or corrective? Well, if it is an impulsive move, implications that should follow after an impulsive move should be different than the implications that are following after a corrective wave. For example, we take this one from here to here. Is this an impulsive move? Well, it must respect all the rules of an impulsive move. But what are the rules of an impulsive move? First of all, it must have a five-way structure, and it must have an extension. This one in here, it has no extension. Why? Because if you measure the length of any specific leg, let's say this one, and then you compare the outcome with the other legs, this one in here, or this one in here, this one in here, we see that they are almost equal. This is not happening in an impulsive move, and if it's not happening in an impulsive move, it means it's not corrective. As we have only two possibilities, it is either impulsive or corrective. Well, if it's not impulsive, it must be corrective. And then, if it is a corrective wave, the very next question that you should ask, what kind of a correction it is? Because if it is a simple correction, implications are different than if it is a complex correction. Well, so far we said that this is a corrective wave, but let's see, is it a simple one or a complex one? Well, normally it should be labeled something like this, being wave A, and the B wave, and the C wave to the upside, A, B, C. If this is an A, B, C to the upside, then we got or it must be followed by an X wave, because the first zigzag is completed and the X wave. And then we have another A, and the B, and the C. A, B, C. This is being called a double zigzag, and normally this kind of a double zigzag is a complex correction, and it should be very interesting to know that this kind of a complex correction is rarely being 100% completely retraced. So if you look at the base in here, and then you look at how market reacted from that moment of time, you see that it is not retraced by a wave of the same degree. So the thing to do, or how to trade this one, is to go and take a Fibonacci tool from here to here, and then to go and trade binary options every time market comes after market comes more than 61.8. So in here we'd like to trade a call option. Well, market still dips to the downside, but we know that it's not going to be completely retraced. Then on the next level, on the 70%, we're going to trade another call option with 1 month expiration date, with a bigger investment. The more it falls, the more aggressive will be, with invalidation level being in here. So all this time, all this period, this ones, and this one, and this ones were only opportunities to go and trade call options with as big an expiration date as possible, as this one comes on the daily chart. If the same setup comes on the hourly chart, that's a totally different story, and we should go and engage into trading call options, but with end of day expiration date. Why not? So we said so far that we are looking at a move to be impulsive or corrective, or a move, or if it is corrective, what kind of a correction is that? Stay tuned for the second part, when we will show you more examples, and we'll go with more tips and tricks what to look for in the Elliott Waves theory.